Okay, so welcome everyone to Asset Protection with the Protector. Obviously, with the coronavirus around at the moment, litigation and also family provisions challenge, this is certainly the sign, the absolute sign of the times. This is a great strategy, a great suite of documents, and I'm blessed to have a good mate, Tim Munro, from Change GPS. To discuss with me. Tim will come back in very shortly. So,
hey Grant, how you doing?
Oh, good mate. How are you? See, I was telling you when you were just off getting a Corona. So there you go. So watch out.
Just a glass of water.
I know. So just a glass of water. Now, it was funny actually, Tim. It was when we first came out with the Protector, and that was I think you and I had a discussion a while ago, and you've in fact given us quite a lot of insights on some of the strategies you do with the tax plan plus and stuff like that. So we've in fact got next week an associate lease, motor vehicle lease, which will be released again. So thank you very much for that. But Tim comes up with some great ideas, and when he came up with this Protector and we went through all the requirements of the documentation, it was like, well, unbelievably, I've already got all these documents, and in fact a lot higher standard than what I've seen out there. So we've got the system there. Now we're just tweaking it a little bit in terms of mortgages, etc., and PPSL, which we're working on, and that will be all finalised. At the moment, we're doing it manually. We're trying to automate as much as possible. But when I came out with the Protector a little while ago, it's funny. Actually had an accountant who wanted to try and use it for themselves. Because they got themselves a little bit of a pickle, but it's very hard to backdate these sort of things. So anyway, it's certainly a sign of the times. Now, they're not guaranteed. They're great, absolutely great for family provisions. What we're doing is taking equity out of, we can take equity out of existing individuals' assets they hold. With a Protector, you can actually go down and also take it out of spouses, so jointly if you want. You can also use it to take equity out of a trust where you might have some cash or assets in the trust or goodwill, which is valued, but it might be a risky business. So we can move that. It's a proactive strategy. Unlike the accountant, you don't want to be in a position of being too late because obviously you've got to worry about the doctrinal clawback. But we'll put the heads up on that one. We are getting an insolvency barrister write a letter for us, a letter of advice, which will become part of the pack. So that will be interesting, and I know Tim's got a whole lot of questions to ask the barrister, and as have I, so that we can have a really good FAQ around it from a legal perspective. As I said before, the best thing for is estate planning. If you've heard me before, in the Angela Miller and Andre Taylor case over in West Australia, which concluded in 2018, it was over a $600,000 estate, one very simple home, but there were more than $500,000 in legal fees spent. So what we'd like to do is, and we'll go through, is it's great to have the Protector there to effectively make sure that when we do pass away, that everything is in a family protection trust rather than in individual names. So when the lawyers come knocking for their no win, no fee, then effectively there's nothing there for them to feast on. But anyway, you want to have a bit of a chat on your background on the Protector, because you've been around it for a long time and using that gift loan back strategy, Tim.
Yeah, Grant. Well, hi, everyone. It's great to see so many people along today. And I think with what we're doing at Change GPS with the business continuity plan, one of the things we've spoken about was the wills and EPOAs that Grant and I, your docs, have put together. And just to let everyone know, we're about to release a GPS system on that to make it simple. And while Grant's put together an awesome letter and the documents here, we're actually putting together a system on the Protector. And I can even, if we show a screen later, show you the document I'm working on, just to make it easy for you as the accountant to help your clients to understand the value of this service. Now, to me, it's absolutely crucial. I love Grant's approach for getting everything right in your self-managed fund. But right now, it's far beyond that. It's how do we protect assets in our own names. And Grant's approach, which is altogether a different webinar, but he's been taking the approach of using the leading member concept to have a key person decision maker in a family group, make them the leading member, like the British royal family, and then having your lineal descendancy go from there and protect assets in that line. And using the protector means that we can get assets without moving them, and having possibly CGT if it's investment asset, but if it's a family home, it'd be stamp duty and other costs. Without incurring those, moving them, the equity in a cost-effective manner into what Grant described as a family protection trust. And that way, mum and dad who run a business with personal guarantees and all sorts of things can sleep so much better at night. We right now have got about 14 clients on the go that we're just starting this week, this process with. We've done it for about 3 or 4 clients over the last 2 months. And this is just straightforward work that clients absolutely love, Grant. They really love it.
Can you, again, I think if we have a look at this, and look, I've used this. This originally comes from Tech. It's Gary Moore on the introduction of any cycle. You can use it for a strategy. You can use it for a business or whatever. It's quite funny now. And look, I'm just going to go a bit off base here. But what I see now happening with the decimation of business and everything that's going on at the moment, that we're all clinging by our fingers. But I believe once we get out of this coronavirus stuff, people are actually going to start to remake their businesses. You know, they may not have so many staff on, they may not do this. This asset protection is going to be a lot of people thinking, oh my God, why wouldn't I have had that in place from the start? So that I know everyone who's on this presentation are definitely down at that early adopter level before it comes down to a later stage. And certainly Tim and I are at that innovator level. But how are you seeing it all? It seems to be squished together these days. It's not long-term. It's not a long-term thing. Everything is moving so quickly for us in business, and particularly the accounting business.
Absolutely, Grant. Look, when we did our web event the other day, we said there is no playbook for what we're going through at the moment.
And how did you have on that? You had a huge amount.
We had about 1,860 registered, and most the peak attendance is about 1,548 or something. We're about 1,440 on for about an hour and a half, which was just insane. But that to me shows that they're just no one's, I think, ever had webinars with that many people on before, and that it shows the interest that there is out there for I suppose for helping people. And from an accounting point of view, you know, accountants have focused on your BASs, your tax returns, your financial statements. But with what has happened, it means that's why this curve is squished, because our clients are wanting help in insolvency. They're wanting help in asset protection. They're wanting help in estate planning. They're wanting help with their EPOAs. They're wanting help with their cash flow planning, and all these things that accountants haven't done before. HR, you know, and how do you stand down employees, whatever. All these things now that we've not really done, all of a sudden we've had to skill up on super quick. And I know, you know, I'm doing 16-hour days just to keep on top of things because the law's changing every night. And then we have, you know, HR and helping our employees and get people on job seeker or everything else like that. It's a total new ball game. And, you know, Grant, the accountants to stay on top of this. When we come out of it, and we will come out of it, they will be blitzing. Absolutely.
Yeah, you've got to see the people who focus in on compliance. They're down there. They're the laggards in the late majority. You know, accounts can't do this. This isn't the, you know, we just got to do compliance. And you'll see that over time, and you would have witnessed it anyway, that, you know, the last 15 years, what you used to do with accounting returns and tax returns and compliance compared to now, with all the feeds from Xero, you know, with all the tax packs you've got, it's a completely different process, which means that it's becoming a lot more automated, and automation seems to be the way to go.
Yeah, 100%. You know, compliance will always be there, and compliance is going to be essential for everyone to, you know, get their cash boost, though I don't think that it's going to be too successful for a number of reasons.
I think it's hopeless, personally.
But I won't go into that today. But look, it's essential. But right now, like, my clients are smashing me about. I just had a Zoom meeting just right before this with one of our clients that we need to protect the equity, 5 million worth of equity in a trading company by kind of like a loan and PPSR arrangement that I'll need to talk to you about afterwards. You know, she's setting up, we've already set up these documents, we've got to finalise the registration of them. That's the thing that is on top of clients' minds, protecting their assets so they don't lose them. And that's why today's webinar is such a big opportunity to everyone on board to look at this and roll this out quickly.
And that's why I call it a moat. So what we're doing is, if you think of the ravages of the hordes of lawyers who are sitting outside, but it's also the regulators. Look, I got caught up once. I think I got a couple of fines for over in Adelaide for speeding. I was only just over a little bit, and sort of I just let them go because I moved up to Queensland. And next minute, $1,100 was taken out of my bank account under a garnishee notice. And the tax office and the state governments, they've got access to absolutely everything. So we want to make sure we keep as least as possible. So the motor is a great one, is a good asset. The protector is a good, strong one there. And then obviously when we start to have a look at our wills and our testamentary trusts, have a look at our enduring powers of attorney, we start to look at these leading member trusts that Tim was talking about, and we put ourselves a really, really good, strong moat. Now, just want to talk, we'll go down, but how you approach it with your clients. So how do you explain the process? And more importantly, who's it for?
Well, I'm looking at any single client that has got, well, let me go back a step. If they've been a client of ours for a while, we would have already run an asset protection review. And that's going to be to help everyone using Change CPS. At the end of this year, we're going to have a app which allows you to basically put in what a client's got, and we'll give you a beautiful report which explains what it needs to change to. But it's going to take us, 6 months to build, so we're starting to scope it. But what I do is we like to separate risk from assets. And so we look at what is the risky trading entity? And of course, you should only have, if there's a family group, mum or dad, whoever's the risky person, that's the sole director over there. And the asset person is in control of the asset side. So if we've done our job with that, hopefully the risky person doesn't have the family home in their name or any other properties. But we get a lot of clients referred to us, and of course, say mum and dad, and say dad is the risky person, the house is jointly owned. And that's not what I would have recommended, but that's the way that it happens. It should have been just in mum's name in that case, if she's the asset person. So, we make certain the mum's not seen in any way to be, like a shadow director or anything like that. So when we look at a client, most of them that come on board, we need to do some protection work straight away. And we very simply, we use a method called VPP, which stands for value, plan, price. No pressure on any client. Because it's up to them, but I just say very simply, hey, listen, you've got $500,000 with equity in your property and that's in your name. Would you like to protect that given what's going on, given that you've given personal guarantees and other things? And I can show you a letter that we've used successfully, which will be part of Change GPS, that for those that are using it, that helps to say, look, the value is $500,000 we're protecting. The plan, we need to do this and this and this. And our price, you might charge $5,000 or $6,000 or whatever it might be. And we say, look, that works out to be like 0.8% of the value of the property or the value of the equity that we're saving for you. Let us know if you'd like to proceed. And once we do that, people just say, where do I sign? So it's no good just going and saying, look, it's going to cost $5,000 to fix it. We've got to focus on what are we doing?
What's the benefit?
Yeah. We're protecting $500,000 here. And here's something that you can set up and protect it. Client, it's up to you. We're not forcing them, no pressure.
It's great. It's an absolute opportune time because if you think the three big things at the moment for all of us is we all want to be healthy, and we want our family to be healthy. We want to be wealthy, and then we also want to have our freedom. And within 2 or 3 weeks, would I be right in saying, Tim, that we've had the whole three things taken away, and it's a gut punch to everyone. And look, I'm sure you're dealing with I'm sure you're being pretty brutal with some clients, and they're just going to have to fold their business because by the time the government gets action, it's going to be way too late anyway. But all of those sort of things, that protection mechanism, protecting your family, it really comes to the fore.
100%. And look, that's what we said in our webinar last week and this week. We're telling everyone, it's battle station. We've got the business continuity plan out. And what we said on Monday, and David Boyle and I were talking, saying this is the week, the next week, next 7 days, every one of your clients do a cash flow forecast. Do a simple one. We made one available for free, which we sent out in the kit to everyone, just to look at the viability of your business. Because it's no good putting, most people have got money saved up a bit. It's no good propping up a business where the business model is not going to work right now. Even if the government gives you, interest-free loans and things like that, that's just going to prolong the inevitable, and you're going to have to pay that money back anyway. So you're better off, and we've had to give clients some brutal advice in their best interest this week, and we're in the middle of doing it, and it's tough. Our team is struggling, I'm struggling, every accountant is struggling, but we've just got to keep as positive as we can. And this is the time where our best advice is to tell the client sometimes what they don't want to hear. And if we can help them with that, we are true advisors.
I know, and look, it is trying to be brutal. And as I said, it's we're in that shakeout stage, and virtually it is we've got each of you accountants or planners out there. It's a war room. You've got a war room there, and you're really putting around the chess pieces. Look, we're getting inundated with a lot of queries around the protector, wills and EPOAs. I mean, I did a session this morning. I said virtually everyone in Australia over 18, given the fact that we might be quarantined, virus, shielded, whatever, we need to have an enduring power of attorney in there, because if you're struck down or something's happening, who's going to look after your bank accounts? Who's going to look after your investments if you need to do it? And look, from all of our perspective, the protector is absolutely crucial for us, because you don't trust PI. I would never ever trust PI, and I think that particularly the SMSF auditors, any of us as professionals, need to have this and make sure that when they do come for us, there's nothing there for us. But look, you can see all of those. I mean, you're having a look at some of the clients. You're talking about the entrepreneurial lady before. What other clients you've been working with, Tim?
Right now, I'm about to finalise a massive report to a client of ours that owns a number of service stations in regional parts of Queensland, New South Wales. The client I spoke about earlier had, it was a homeware distributor, to 2,000 different places across Australia. People that I'm talking to are involved, like directors of employment companies and other things like that. Just it's across the board. It's every client, even some employees that are like people that are employed without businesses that have built up some assets, and now they're saying, look, not only do I want to protect them, but I actually want to have the equity in a pot, which is like a leading member trust, a family protection trust. So then they can go in the direction I want without those assets being in their name and then potentially being fought over under a will. I love your approach of making certain that everything's either governed by a super fund with an SMSF will, or everything else is effectively funneled via this protect arrangement into a leading member discretionary trust. And that way you've got complete control over where things go. And effectively the will's like a blank document. Yeah,
look, it's the best thing. And look, just had Ken Race on, a good mate Ken, and he was saying, look, there's a lot of baby boomers out there who need protection, because the last thing, they build up investment properties or a series of investment properties, and their pricing's probably gone down a little bit, and all they need to do is have someone make a complaint or fall over one of their properties, and basically it's all over. It's funny to know that Australia is provides the most law students per head of population compared to anyone else in the world. It's crazy. Anyway, let's have a look at what it looks like, and then I'll do a couple of things for you, because I want to make sure that Tim comes in and show you his stuff at the end. So I'm just going to rip through a couple of things. So it's a three-step process. So first off, we've got a client, but as I said before, it can be a spouse as well, or it could effectively be a family trust or a family company. So what we've got to do is work out the net equity, basically, that's sitting in there. And then we have to set up a family protection trust, which from my perspective, I call a leading member. So it's pretty simple. What it is, it's a trust, and we start off with a leading member. So the easiest way to think about it is the Queen. So then what happens down there is there's a difference between lineage and bloodline. You can choose which one you want. Lineage it's all the bloodline down below the Queen. Whereas if you look at bloodline, that actually extends out to her sister Margaret, her nephews and nieces, etc. So you can start to make a choice there. So the first leading member is the appointor, and then below that is the next person who's coming in, the appointor, and the person after that. Now we want to have that succession there, because the first person we're in there, if they start to attack this trust because there's been a separation or family law, we actually want to bin that person who's the appointor, take them out of the equation. And you can see up the top here, the Family Protection Company, that's a trustee company. It's a special purpose there so that the leading member owns all the shares there, because the last thing you want from an estate or litigation point of view, those shares being exposed, because if the trustee in the bankruptcy or the executor under a litigation holds those shares, then it actually holds that whole trust to ransom. And take it from me as well, that's not only just for this, it's for SMSFs and family trusts, but this is a built-in process. So the leading member appointor holds all the shares, obviously controls who can be the trustee. If they bow out, die, become incapacitated, or simply resign because there's potentially a trustee bankruptcy claim against them, or more importantly, there's a divorce, they bow out, then the next person who comes in as a succession as the leading member, they then get issued those shares. So the first lot of shares are cancelled and the new shares are issued. So it's a very, very strong protection mechanism. Again, everything I've built is to get that moat around it. So we work out the equity.
Grant,
yeah, go for it.
Can I just say that is sheer genius, what you've put together with that. I don't think everyone realises just how powerful that is, because we all understand, assets and trusts and companies aren't effectively covered under wills. But the problem is that, as you've said, if the leading member, the main person in a business, die and their shareholding is in their own name, whoever is the executor of that estate effectively, kicks off the party. Instead, what you've built into your leading member constitutions for the shares to be instantly cancelled and the successor leading member to actually receive those, that means that you've got a guaranteed succession which doesn't have to wait on anything happening with the will. I think that is brilliant. And so we are actually putting out recommendations to all of our, starting with our large clients, to actually change the constitutions using the docs of our trustee companies and also the trustees for our SMSFs, and also upgrading the trusts for each of them. So we've got the leading member concept inserted everywhere. To all the accountants on board here today, this is absolutely vital. Like, you'd have enough work for the next 6 months just focusing on this for your good clients. So yeah, I just want to say, Grant, what you put there, that strategy, for the first time, we've now got an option to for the assets out of the
protection.
Will, absolute correction. I love it. Yeah.
I know. Well, it came about, a good mate of mine was caught up. He came in the back end of the litigation, and what had happened, it was a self-managed super fund that had about 3 million. Dad died. There's quite a lot of strip shops in there. Then there was also a family trust as well. And you'd say, well, hold on. And she was to receive a pension. And so you'd say, well, hold on, everything's protected, except both of the trustee companies, the shares logged into the estate. And then there was a son who was caught up and was a bit of a ne'er-do-well, but had a very, very aggressive lawyer who came down and crunched on the executor. And you know what executors are like. Here's the first thing, guys, make sure that you always get a good executor who knows what they're doing, because if a lawyer comes in, crunches down on them, puts the fear of God into them, they end up like deer in the headlight stuff. And nothing happened there. And in fact, they missed 6 months of payments from the family trust in terms of interest, and the bank was actually going to foreclose on them. So you've just got to be really careful. That's how this whole idea is. I was thinking, well, how do I put that moat around and protect it? So it was cancel and then new ones come up, and so we'll always go. Now I've got a couple of questions here, so I'll look at one of them. I'll pass one over to you, Tim. I've got one from Andrew. If I'm protecting my equity, I'm the leading member of this new structure, or is this another family member? So if it's your equity, Andrew, you actually become the leading member because it is your equity. You want to be in control. It's your money. You want to sit it in there and do as you see fit. As Tim said, you can even go through the process of making investments. But again, if something happens to you, or you become involved in litigation, or more importantly, if you become part of a family law action, then what we want to do is just put our hand up and say, I'm out of here, and then effectively the next leading member comes in. So you've got to be really careful about the next choice and the choice after that. I've also, just as an aside, one of the classic situations we've always done for asset protection, and Grant's here to tell you not to do that, is we've put assets in our wives' names, which sounded good many years ago, but the problem about that, then there's no control. So this style is much better. Now, Tim, we've got one here from Roy who's saying, can the trust be a company instead? Shares in the company held by a trust instead?
Look, Roy, that depends what you're trying to achieve. See, what we want to do is have the equity held by an entity. So yes, look, it could well be a company, but if the equity is held by a trust, to my way of thinking, it gives you better options as far as how to do things with family members as time goes on, rather than be caught up in a company. So my strong preference is that you'd use a leading member company as trustee for a leading member discretionary trust to receive the gift of the equity.
Okay, a couple other ones here. We'll go through the process where mortgages and all that come in. Then I'll go and build one, and then Tim can talk about the comms and all that sort of stuff. Gary's got a really good question. In fact, you've got a few good questions, Gary McPhillis. Can I use my existing DFT? The problem about that one is that if we use our existing family trust, which is okay, we could go through the process. You'll see on Lightyear Docs, you can actually change it to a leading member trust. You've just got to be careful, Tim, don't you, as to what is actually sitting in that trust, if there's any exposure. So the last thing you want to do is put equity into a trust that may get a problem.
Yeah, Grant, we recommend, when we're doing this, we actually charge, normally around $5,000 for doing the gift and loan back and everything like that, because there is a number of documents and there's a fair bit of work with the registration. We always then quote to set up a new leading member trustee company's trustee for a leading member trust. We charge $3,000 for that. And we always recommend, if you're going to do this process, get this set up, because this is effectively your family protection trust, and it's going to last for a long time. And you don't want to use an existing entity with skeletons in the closet. And secondly, if you use an existing one, you'd have to do a deed upgrade anyway to get your leading member provisions in it. You'd have to change the trustee, possibly, or you'd have to upgrade the constitution for the trustee company, because what's in the constitution blends and links to what you've got in the leading member trustee. So strong preference is to start afresh. But what I do, just so everyone's aware, and I know, like, when you look at, like, it'll be 3 for setting up the company trust, 5 for doing it. So you're looking at 8 plus GST. We offer our clients quick fee or Mueller pay, and that way our clients can pay it off over 12 months. So you get this now, we get paid now, and they can pay it down over 12 months. So I reckon that's a great option to give them that protection.
Yeah, particularly this time. Actually, just had a question from Wendy. Obviously, she got caught up with her father-in-law around estate planning. Again, this is perfect for estate planning. In fact, I came to it from an estate planning perspective, but Tim came in from a business. So it works really well for both. So if I just go down to our strategy automation, we do a lot of, with our automations, what we're doing is it allows us to put like 3 or 4 together. And I'll just rip through and build one quickly. If you just want to have a chat, Tim, and they'll all see me build the stuff on the system, and then what we'll do is we'll come back. In fact, I think I've got, I shouldn't say, I built one the other day when I was doing the conference. So let me have a look at my vault. So every document that you build in the Lightyear Docs system, there we go, the protector, effectively sits in a vault. You can see I've changed it a few times, and I'm just relaunching there. So what I've got there, it works really well, best in the new Edge. If you can see this, you've got a new Edge. It's Hopus on IE. We've got a document set up. I've set it up in the vault you saw as the conference. So you can go back and you can relaunch at any point in time. You saw this one document. I've actually launched it 4 times, so I've made tweaks and changes and all that on the way through. So you lodge it. I know it's a Smith Protector. You put your client's name in with the logo. If you're on our system, send us through your logo. So I know Tim's got his Change GPS high-res logo. He's got his own code, puts it in, so it all pops up with a Change GPS logo. Alternatively, you can use the old default Abbott-Family, which is the legal firm.
With the documents that we do, like trust deeds and documents like this, we use the Abbott-Family logo because I want clients to really understand these are documents produced with the backing of a legal firm. Yeah. So there might be some documents we put the Change logo on, but majority we put the AM001 for Abbott-Family in there, and we think that just really reinforces the quality of these legal documents to our clients.
Again, they've all been signed off, and as I said before, we are getting a letter of advice, which we'll be able to add to it as well from an insolvency barrister. Now, importantly on that, we went through a big session this morning on wills and TT. We went through our new system, which I think is absolutely awesome. And from that perspective, what we did is we went through as to where that legal services stuff is. But a lot of this is really just a data dump that you've got from the client. So, and you're giving it mainly around tax and other advice as the accountant. So it's not the provision of legal advice. So what I've got here is I'm looking at the common parties. So I've got the first one. I can go as an individual. So I've got John Smith here as an individual. I've put them basically sitting in there. And then I've got the spouse, Sally Smith, as well. I put in the details there as well. And now what I've done is this is a joint transfer of equity over into the trust. Now, if I wanted to, when I do my document setup, I've got the common party, put those in. I then got to have the leading member trust, or you can call it the Smith Family Protection Trust. Whatever you get around, what really shakes your nerves is great. Now, when it comes down to the documents, so I've already got a trust that's established. If you haven't got a trust that's established and you're going to settle the trust, and this becomes important. So as Tim said, if you want to go down and do it afresh, if you do that, then you're going to end up with a leading member discretionary trust. So as you can see there, we're actually starting to put in the first leading member, the second leading member, and also the beneficiary, which will be basically a choice of lineage or bloodline. You've also got a choice as to whether the spouse is included or the spouse is excluded. And that's up to you, up to the client. We want to give them all choices. So if you want a company, you can put that up there, and then you'll see a whole lot of company stuff will poke up. But just for the interest of time, I'm going to say we've already got it set up. So the key issues there is we need to say what documents do we want. We want the solvency certificate. So do you want to just go through what a solvency certificate is there, Tim?
I reckon it'd be great to explain all of those, how they all fit together. And including how promissory note works and everything like that, just so everyone can understand briefly.
Okay, so let me go through. So we want to do the solvency, the deed of gift, the promissory note, the loan agreement, mortgage deed, and personal guarantee. So I'll actually go in and show you how we fill it in. So the first thing is we need to know the name of the account. So I've got David Sidhu from IPS, and that'll become, so we've got please enter the account details. So this will be Tim or your name or whatever. We then go to the gifter, the person who's actually going to be gifting the amount of equity. So Tim's showing you how to find the actual amount of equity. And then what happens is we effectively are going to be the gift. Here I'm going to make it the individual. So I'm just going to make it John Smith is going to be the gifter here. But as I said before, I could have made it because I put it in there a trust, and I'll talk about that maybe a little bit later on. So we're just going to do it from John, and also then we've got it from Sally as well. So that's a joint. The giftee is obviously going into the Smith Leading Member Trust. So we're transferring it over. If I go back to my little diagram here, I've set up that Family Protection Trust. I've got the company there. I've got my family beneficiaries, which are lineage or bloodline, plus obviously any entities that are associated with them. So we can easily put a bucket company in there, but again, it has to be owned by the lineage or the bloodline. We're settling or the gift. So if we're actually doing this, we could use some of the money to actually settle the trust, or we can gift it over. So we're going through the gift process here. So if I just go back here, what I've done is I've got the gifter, the giftee, and then I've got the gift amount. So we put in the date of the deed, cash, shares, unpaid present entitlement. So it's not a bad idea. If you've actually got shares that are underwater at the moment, you can transfer them over because there's no CGT. So you could put those shares in, or alternatively here we've got 2.1 million in cash. Now we haven't got the cashola, so what we do is we use a promissory note. So who's the promisor? We've got an individual, so I use this one to show someone else. I've got John Smith, who's the promisor. If I wanted to add another, I could easily add Sally in there. I just have to poke that in, but I won't do that one there. So just let me take that out from that. So I'll just delete that. So delete the repetition. At any point in time, you can save answers, preview the document, or whatever. So we've got the promisor going through there. I've then got the promisee, which is the leading member trust. As I said before, you don't need to fill all this because you've already done it through the common parties. We then go to the execution details, the termination date of the promissory note. So I've chosen the 10 years, but you can go 10, 15, 20. The promise details are 2.15 million. So I've put in $500,000 as a compensation payment. Again, rather than just put 2.1 over, I'd like to see some compensation so there's consideration that is actually showed on there. There's been a couple of cases around this. So we are going to pay a compensation payment of $50,000, but there's no late payment fee. Now it's gone over, so now we've got the trustee of the Family Protection Trust holding that promissory note, and what they do is now enter into a loan agreement. So we then go through, we've got the lender there, so that's going to be the Smith Leading Member Trust. And again, all I do is have to poke that down and just pre-fills in there for me. I've got the borrower, which is, again, this was the family trust, so I'm going to change to the individual. The borrower is John Smith. And then I've got Sally Smith, so I'll just delete that one. So that's if I wanted to do a joint, I'll just delete her from the repetition. So this is just straight for John Smith. And then I've got the agreement details. What I've got there is Queensland, the principal loan amount is 2.1 million, 10 years, 2%, interest payable at the end of the loan term. And then effectively, if we have a look at, there's a personal guarantee as well. And also I've got a dated mortgage deed. I've got a mortgage over the real estate, and I've got the folio number, so on and so forth. So the only thing I have to clean up, and I'll come back and look at this a little bit later on, I'll just take, because that was joint, I'll delete that. So it just shows you how I can put it in and change it up. So when I finish that, so that's the whole suite of documents going on from there. And then we'll go step by step so you can actually see. But it takes, you can see no more than probably a few minutes to go through that process. So I get a PDF there, but remember at any point in time, if I wanted to, I could easily just go in here, go into my vault, go into the conference there. We saw that, and then I go down to the protector. Remember, this is the one I just worked on. And you can actually see there, that's the one I just did, March the 26th. Exactly at 12:10, and I can then load that up, and I'll show you if you need to change any details. It's very easy to go back in. But effectively now I've got the document here, the PDF. Up it pops up on the screen. So we've got the protector there, and included in this is all the documents: the solvency certificate, deed of gift, promissory note, loan agreement, mortgage deed, and personal guarantee. So we then go down. Do you want to cover that one for me, Tim?
Certainly. What is important is that when somebody does this, it's very clear that they're not doing it in an attempt to defeat their creditors. So if someone had $1 million equity, but they owed $2 million, you couldn't do this because that'd be something, that you're trying to defeat your creditors. What we're trying to do with the accountant's solvency statement is for someone independent, so like someone independent of the client. When I say someone independent, not a family member, it's really someone else. So the accountant is obviously the logical person to say, hey, listen, John Smith, I confirm that he's able to pay their debts as and when they're due at this current point in time. You could even expand that out and say, look, here are a list of assets, here are a list of liabilities, and this is the equity amount, and we're happy that right now the client is solvent. And that just gives more, I suppose, validity to then the documents that are signed after this, because it's proven the client has the capacity right now to be able to do this. Back to you, Grant. Can't hear you.
I had it on. Yeah, I had it on mute. Sorry, I was just answering a couple of questions, silly me. So now this is the deed of gift between John Smith. Remember, I had originally between John and Sally Smith, if you wanted to do that, or I had the trust, but it was easy for me to just go in and actually change that. You saw me change it in front of you, and I'll come back to that a little bit later on. So I'm giving an amount to the leading member trust, of which obviously John Smith is the leading member. And then below that may be his kid, or it could be his wife, Sally, or whatever. So I've got John Smith, Smith nominees. This is straight out of our deed of gift. This is also an important document, the deed of gift. I'm just taking a segue here. It's really good when we come around and do trust distribution minutes. If you've got UPEs, use this deed of gift to get rid of that UPE from adult children. it's a good idea. I'm sure there's going to be lawyers around at the moment who are going to be tapping kids on the shoulder to see if they can get UPEs from the parents' family trusts. But anyway, we go down the track. It's a pretty strong deed of gift. We go down and you can see there's the gifter, there's the giftee, and then we've got $2.1 million. Now, we haven't got the cash at that stage. Remember, it could be cash or it could be shares. We then go to the deed of promissory note. Again, there's full consideration for that. As long as it's legal, AOK, you've got a couple of really good cases on that one. So the promisor is John Smith. Promisee is the leading member trust. We've got the period there. It goes through to 2030. You can see there's the compensation payment there. Termination date is the 23rd of March 2030. But look, if you have a look at that, if you wanted to go and make a change, you saw how easy it is. Just go and relaunch, put the change in. These are all set as draft documents for your clients until they come in to sign. So again, you've got the promisor and you've got the promisee. Now we get into the loan agreement per se. So the lender and the borrower, I don't think there's anything like really dramatic around that. It's all got Abbott-Family on. And then the real thing is we come down to the schedule, and the schedule should be $2.1 million. So we've got that over 10 years, interest variation at 2%, 24th of March 2020, and we've got the charged property sitting over there. Now, we've got a deed of personal guarantee. Most gift and loan backs that I've seen don't have the personal guarantee, but we want to put a moat around this. So we want this guy out of the equation altogether. We don't, if anyone tries to say, oh, this guy's got a lot of money, and it's used quite often for, I shouldn't say hiding, but corralling assets from second spouses and from children. So the children think they're rich, but when it comes down to it, it's actually all sitting in here through that loan. Now we have that loan with security. We put the personal guarantee in because then there's a lot of enforcement that the trustee here can place as opposed to the trustee in bankruptcy. So it's preference for me, which we've built in here. You don't have to have it, but there certainly is a preference for me to have that deed of personal guarantee. So we've got the personal guarantee there, and then we move into the mortgage deed. So the mortgage deed is from John Smith to Smith Leading Member Trust, and it is over the a property there, so which we had the property which is at 5 Smith Street. Now, do you want to just go through the process on that one? What needs to happen for that, Tim?
With the sorry, Grant.
Mortgage.
With the
So how you've gone and had a chat with banks, because obviously the bank's going to have first mortgage. You've got a second mortgage, and then we need to go through the process of registering it.
So what we've actually done is in the letter, in the report that we've put together, which I'm just in the middle of upgrading, and I don't mind sharing that if you want me to share my screen later.
Do you want to share it now?
Yeah, look.
Yeah, because we've gone as far as we can in terms of the elements. So I've stopped sharing. So if you just want to poke yours up there, it'd be great.
Let me just see if I can make this happen. Share screen, main screen, fantastic. Okay, so can you all see that? Protecting the equity in your family home. Can you see my screen there?
Yeah, I can see it. Yeah, I've got it.
Right, okay, I'll just make that a little bit bigger. So this is in the form of a letter. This is what we have used for our clients up until now. But then we're putting this into a standard change GPS report with quite a few other things. So what we've gone through here is saying, look, we want to help you protect your equity. This is using our VPP approach in Change GPS. The value of our advice, we want to protect this equity. The plan, so we've gone through and listed all the documents that will work using the system to create. And it speaks through the transactions here so someone can understand it. And we've got this highlighted here. As your bank holds a first mortgage over your property, as it would for most occasions, their consent to this second mortgage will be required. Now, really important for you to understand, I've spoken to a number of bank managers about this and none of them have had any issues. Don't think that the bank won't act and support this, because I position it as we're trying to protect our clients' assets, and it's actually in the bank's interest that these assets are protected. And so once we've explained it, they're happy with it. Sometimes they might need their lawyers to have a brief review of the documents, sometimes they don't. And that's just on a case-by-case basis, but we always flag that up front. We go through here, explain about the price, 0.8% of the value. So that's effectively the price. And we might, and look, we'll also add in the 3,000 for the leading member trust in there. So it might be like 1.1%. That's a good price to pay to get that protection. And here we go, next steps. We always finish with next steps. Let us know if you'd like us to do it. We'll send you our tax invoice for upfront payment. Also, we'll need to have a phone or Zoom meeting online with your bank manager so we can explain it to them and request their assistance. So that's just a very basic run through of how we're putting it together. But we will be putting this into a proper asset protection and estate planning report. So we'll have one just for using Protector, but then one for looking at the entire situation. And I might flick this down just to give you a bit of a sneaky peek as to what I'm working on. Grant, you haven't even seen this. But
you're getting me excited here.
Yeah.
Who cares about this coronavirus when you have a look at how good this sort of stuff is?
So we're going through here objectives and concerns, 5 principles for asset protection for business owners. Then we're looking through key asset areas of asset protection, and then we'll go through and say, right, I'm starting to develop up your leading member concept here so people can understand it, and then we'll go into the Protector. So I'll stop the share at the moment, but it just gives a bit of an idea as to where I'm trying to take this to help accountants that are doing this, and also help their clients to understand we need to bring your bank into this, and we'll make it what we're developing in Change GPS. I like the front end documents to help you to educate your clients and get them excited about the value you're going to create and then how to charge them. And then you go straight across on the Lightyear docs. And I know there's been a few questions. You can sign up Grant will take you through this to one of their packages to have unlimited use, or use it on a document basis.
Okay, so with that one, I think there's a couple of things. So we obviously go through the mortgage, but I'm just going to go in. It shows you easy. Remember, I went back in here. So this is the Smith Protector. I'm going to go back in. I'm going to relaunch it. I'm thinking, oh God, I made a mistake that the house or the property wasn't there. I know someone like Ken, you'd probably have to put in each of the investment properties. So you'd have to go through the bank with the mortgage. But if I then go down here and I have a look at I've got the lenders all through there. I've got the borrower. I've got the agreement details here. So if I then go down here and I'm looking at doing the mortgage, now it might be over other assets. So for example, I may go through just to show you how quickly it can change. Now I'm doing a bit of a scammer here for you guys. It's just to show you that original document I just did for John Smith, if I wanted to, and don't tell everyone else this, but I've got the accountant, which is okay. But what I could do is the gifter which is what I did the other day. So we've got a trust. So we've actually got the Luke Planning Business Trust. So what I do is I do a new document for Luke Planning Business Trust. Goes in still the Smith leading member. So you can use that leading member trust for multi-gifts. Again, I've got 2.1. Let's just make it 1.1, which I've put in there. Promisor is not John Smith. We're going to do, it's actually the trust. So I've got the Smith Leading Trust. So I've already put the Luke Business Trust in there. Luke Nominees. Promisee is still going to be the same. Details of execution, same. Promise details, same. Actually, no, if I go up, it's only going to be 1.1 because I changed it. So I'm just trying to show you what it looks like when you change. Borrower. So I've got the lender. Borrower is now going to be the trustee of the trust. So that's the Luke Trust. We've got all the same there, and we've got a company there. So that goes through there. Hopefully it's all going through. Same, except here it's going to go 1.1. We make all the payment at the interest payable at the back end. On that one, Tim, so if we have a look at it, there's really not going to be much if we've got all this gifting going in, as by way of promissory note, there's really not going to be much when it comes around to compliance and returns, is there?
No, so it's a pretty basic trust. So we normally charge, just for a trust with not too much in it, $750 plus GST up to $1,000 plus GST. And what we do is we register the gifts that have come into the trust, and we register the amounts that are owing to the trust, so they're assets of the trust. And then it's just really presuming the trust does nothing else. There's no need to have tax returns lodged. Lodge a tax return not required. And but it's important to have those accounts up to date and correct in the name of the trust in case you've ever got to act on anything. You could use this trust. I've got no problems with using this trust for investment activity. So you'd also use it to hold possibly shares in other entities, or share trading account, park cash in there, whatever it might be. So this is like your family vault, this trust. Your leading member super fund and this trust, the combination is the vault for the assets of your family.
Now, it's quite interesting. If you have a look here, what I did is I switched. Remember, John Smith was over his property and all his equity. Now what I've done is I've got rid of John Smith. I'm actually using it. This was for a financial planner's business. So what we've done is in a family trust, so it's a discretionary trust. We've got there now, it's not real estate, it's all the assets of Luke Planning Business Trust, including goodwill and chattels. So I'll then go and finish that. So backed off that exactly first set of documents and common parties, I can actually build a whole lot of different documents on that and cover Sally, I can cover John, and then I can cover the family trust quite separately. So I shouldn't do that because obviously going to cost us a lot of money, but we're there to help you make business. So now I'm going to flip out the protector. Everything will say, okay, same. But now have a look at this. I've still got the same account, but it's now in relation to Luke Nominees as trustee for the Luke Business Trust. And then we go through the whole process. You can see I've used the same documents. I've used everything, but what I've done is I've just had to work out solely the name of the family trust. I need to find out what the net equity is, which is what Tim was saying. And then what I've done is I've then just had to replace that system in there. And then basically we're off and running. Now, what will happen there is I've got a mortgage over there, but it won't be a mortgage over the property. It's actually going to be mortgage over the assets of the family trust. So that may be where we use PPSL rather than obviously the bank and also the relevant OSRs and the registries. So that just shows you how quickly you can make these things up for a whole family and get really a lot of value, as Tim was saying, in terms of what you charge, etc. Now we've just got a couple of questions. We'll go through and we'll get to the last slide. We've got a few questions, so please feel free. Help me here if you want, Tim. So do you lodge on PPSR? Absolutely. So Ken, it's a good idea to lodge on the PPSR as well. So Andrew Bashar, for basic users, does the pricing on the LYD website include printing and postage? No, it's an extra $50 if you want to do printing and postage for that. Andrew, for the whole of the protector, as I said, you can do at the cost of it's $450. But then again, you're going to get that return pretty easily. But you can see if you had a look at what I did, I actually did 2 protectors out of just that one pricing. For those of you who are already on the subscription like Tim, then it makes it a lot easier. If you have a look, okay, so Andrew Bashara, okay, I'll have a look at that about the standard company. So thanks for that. I'll go and have a look. Yes, it's ASX price variance. So I'll go and have a look at that one. There's also a couple of questions there from Andrew Martin. As a family home builds up additional equity over time, I presume you just rerun the same document strategy in the existing protection trust. Yeah, so that's the case. There's a 6-year statute, as you said. So each year you can actually just run the same protector so that if I go through next year, obviously it's gone down. It's better to be, I suppose, higher on the side of caution, particularly if we're going through valuations now. I mean, what are you doing now at the moment, Tim, with your valuations of your client stuff?
Are you talking about like with the valuations?
Yeah, so like you're going in, you've got clients at the moment, so valuations are pretty iffy at the moment. So what are you doing around that for your clients? You're keeping them high?
I'm keeping them as high as we reasonably can.
Just flexibility.
Yeah, exactly. Look, we're what, a week or 2 into this. No one's buying anything. I don't think there's effectively any change in vals right now, but there will be as things plummet over the next period of time. I'd keep them as high as you reasonably can right now.
So when we go through and as I said, I've just relaunched the document again, and if we've had an increase at any point in time, we've had an uptick in our whole process, we can go through and just simply go through and launch another document. Seeing everything's there, you just launch it out of the same position, and that will actually increase the process or equity as we go through. So rather than embedding something within the document itself, it's better to go through and get a whole new set of documents that really is in there. Would you charge extra for that, Tim? I know a lot of people do.
Yeah, look, I would. Once again, anything that we do for a client, if it has a value, we should charge for it. Like if there's no value, we've got no right to charge for it. But if something changes and we need to update it, yes, I would charge. And it just depends at that stage, which of the documents, is it a complete set or is it partial? And I think that's the next thing we need to look at. There might be like an upgrade amount process rather than a full process. So I'll have to chat with you separately about that to see what's the best way to do it.
Okay, got another, interestingly, a lot of the stuff we're doing, like the wills and TTs, a lot of the stuff I did this morning, plus the protector, Natasha, the beautiful thing about this, it's not financial advice. So Tim, I know you've got two parts of your business. You've got your planning side and then you've got your accounting side. So how do you cope with this? You just put this straight through accounting firm, don't you?
Yeah, this is done always in our accounting side. This in no way is financial advice. It's not financial.
It's not financial product, yeah.
Exactly, yeah. It's all strategy, what asset protection is. So we've got no problems doing this in our accounting side.
Philip Stock says, should we should not be checking the trustee's full financial situation, or is it just based on what is in the protected trust? If it's just a separate trust, then effectively it is going to be, you just check what's in that protected trust. Again, I think if you have a look at our system, apart from the asset fees, everything's incorporated in one. So it's a strategy automation. You can build the trust, you can build the solvency certificate, gifts, the mortgage deed, personal guarantee. So it's a really strong one, all for the same price. So it's better off, and as Tim said, there's not that, it's not a huge amount to actually go through the compliance schedule for it. So, but that's better than putting it into a DFT. Kush, what happens in 2030? Well, you can always go in and do it up again, or alternatively just pick a longer date, which is probably important right from the start. Roy, how much does the individual owe? Is it the money owed for the promissory note plus the secured loan? No, because the individual doesn't have a promissory note. So the individual's actually, the individual's got that promise to pay, has actually sent that promise or that gift over to the person. So effectively what they'll do is the trustee owes that amount, and then how does that work actually, Tim? So the trustee has got a promise to pay the 1.1 million, and then there's a loan back to that at a later stage. So in 2030, what would happen there from an accounting perspective?
What would normally happen is that if you do it out to 2030, like that property is going to be sold at some point in time, probably before 2030. Okay, and so if it is sold at that stage, the bank takes their money, and the money that's left technically definitely should go into the trust because it actually belongs to the trust. At that point in time, you deal with any unders or overs. And then if the client wanted to buy another property, well, they're obviously not going to do it in their name. You could possibly buy it in that trust, or you might set up a second trust to hold properties. So at least this family protection trust doesn't have to deal with any issues with tenants or anything like that. So I would be saying the arrangements stay in place until the property is sold. Also, the property is not sold, well, once again, you do have new documents to reconstitute it because the gift amount would have to increase, over time.
We've got, if you need, Philip, if you need to have to, for example, Tony Anamorlis, our lawyer, to talk to your client's bank, absolutely. So that's not a big thing. But again, you're saying you're not having a really big pushback from the banks. Is that right, Tim?
So I just missed that. Can you say that again, Graham?
Sorry. So in terms of dealing with the banks, you're not having a real big pushback, are you?
No, I've spoken to a number of managers and had no pushback. But having said that, this isn't a common thing, even though it should be. I mean, I'm going to be doing it for every one of my clients. So it's going to take, you might get a bank manager that go, oh, I don't know about that, because they like to take the path of least resistance sometimes. And so that's the stage when you need to explain it. So what I think we might even do in Change GPS is put together a explanation document that an accountant can actually give the bank manager, which talks them through it. And then it might be that, if they need to talk, if the bank manager needs to talk to a lawyer about it, Grant or Tony might have an arrangement where they can, do a legal sign-off or something like that. So that would have to be discussed if you have any hassles. But I haven't had any hassles so far.
With a second mortgage, does that affect other business borrowing? Well, yeah, of course. I mean, if there's a second mortgage there, Andrew, that's going to have a big impact, and you're going to have to declare that. So you've just got to be careful about that. But remember, at any point in time, you can always unwind part of this to give yourself a release of the equity and take it from there. Danielle Romano, in terms of John Smith personally guaranteeing, you don't need to put that personal guarantee if you wanted to. All you have to do is, once we go into this system, if you don't want to do the personal guarantee, I'll show you what happens there, because you can update any document that you want. We just go into the documents. You go through here. If you don't want a personal guarantee, just tick off. If you don't want to do a mortgage deed because you're doing PPSL, you just simply tick that off. So it's not a big issue there. And you can see there, if I produce that, that's the case. So the personal guarantee is just it's just sort of to give that extra strength. Philip, you can't unfortunately do a personal guarantee by a corporate trustee, but you can do a personal guarantee by the directors of the corporate trustee. Again, Chris Becks, as the equity changes, how frequently should the documents be updated, or is there an easier solution? I think personally, because you've got all the data there, it's better to continually upgrade the documents, but I will have a chat with Tim around that if it's a simpler way. I just prefer that if you can pump out the documents easier, then you can obviously get a lot better value there from the clients. Charmaine, if a property owned as tenants in common, so say one client owns 48%, but the loan is obviously all parties joint borrowed as guarantors, is it just their share of the property value? Yeah, so all you're doing is just taking the equity out of their existing property. So obviously it's not the whole property, you're just looking at the equity. And the good thing about it is to get your head away from the shares, the property, the whole thing, and just work out net equity across everything. I know, for example, Tim's got a whole fleet of Maseratis and Ferraris and all that sort of stuff. So he doesn't have to...
Don't have a fleet of them, Grant. It's just one nice car.
No, I'm just joking. So with that one, you just work out the equity and transfer that over. So the beauty about this is, as Tim said earlier, there's no CGT or stamp duty in the case. If a client has received a formal divorce but there's been no final settlement, how would a protector? It's going to be a pretty tough one. If you've already gone through a formal divorce, there's no final settlement. I haven't seen it used in that instance. But
Grant, I'd stay away from that. We've been involved with helping a couple of clients, unfortunately, in some really big divorces. And until there's a final court-approved settlement, I wouldn't be doing one thing.
Okay, that's good. I think it's a good way to cover in that process. I think Andrew was looking at before, Andrew Martin, is if we set it up right from the start and have that line of succession of those leading member appointors, understanding that as soon as that separation happens, or one of the spouses leaves or whatever, then you go bang and then it moves on. That's when you want to have that protector in before then. That's the best. It's the same thing. Then it goes down if you've already got a trustee in bankruptcy sniffing around. It's too late to really put the protector in there at that point in time. Craig Wood, do you know if accountants may have an issue with this with PI, if it could be construed as asset protection advice, Tim?
Well, I mean, this is something that accountants would normally do in their normal course of business. So number one, what I'd always say, if you've ever got a question with PI, look at your policy, look at the inclusions, contact the insurer and triple check. That's the starting point. But from my perspective with what I do, I mean, asset protection is a normal part of my everyday advice to clients with business structuring and everything else. Like if I'm not going to give this, like I suppose if the accountant's not the one that gives it, who should be? It's the accountant's the logical one that is aware of everything that's going on for the client. So I'm 100% happy and comfortable giving it myself. if you've got any questions about PI, check your policy, check the inclusions, and ring the insurer and get something in writing from them so you have absolute certainty. Because you've got to feel, look, I think everyone should be doing this. I don't think this is too tricky once you get your head around, but you've got to make certain that you feel comfortable at the same time.
Yeah, I think the main thing is a lot of people really say, oh, look, I don't know, because particularly planners and that, they don't understand it until they visually see it. But just follow that documentation trail and, get a piece of paper, put it from one side to another to another. It's still with all in the family group, but what we're doing is we're putting a moat around it. In terms of Roy, we've got, with the promissory note, generally it's probably going to be taxable at the end unless it's classified as a security, whereas an accruals basis. But look, I put $50,000 on there. Honestly, the main thing is we just need to have consideration so that it becomes legally valid. So from that perspective, we could easily just put $10,000 there, which should be A-OK. But anyway, look, that's, we're sort of, so surely you're not providing legal advice, that's correct. So if we go down that track, let's just wind it up there. There are a couple of really good cases on this, which I'll give links to. I'll send this video out to you for those who have missed it, along with anything else that Tim might want to send out. We'll send it out a little bit later. But there's a couple of cases there, Pelly and Nolan, Attia and Nussbaum. Both of them show the efficacy of that gift process and the loan back. Unfortunately, what they did is they did it in a family position, and then the person who was in the receipt of it then just kept the money and wouldn't pay it back. So it's a proactive measure. Look, if you're already in bankruptcy, then you're in a bit of strife. As I said, we'll put together barrister's opinion, and it's great for family provision claims. Absolutely brilliant. If we can die with no assets and they're already sitting in the trust, then we are in a good position. Anyway, it's enough from me. And Tim, thank you very much for your time. I know you're such a busy person. I mean, we're all working 16 hours a day, but this is a war that we're facing, and it's a war that we're going to win on behalf of our clients. So thank you very much for your time, Tim.
Absolute pleasure, Grant. It's been great to be here. Look, if anyone's got any questions for me, post them in our Change GPS Facebook community, and we'll get onto it. And I'm sure we'll be getting Grant to talk to more of us in the Change GPS community as we continue to roll out these and improve them. I'm looking forward to the documents that Grant keeps bringing out. So Grant, thanks for what you're doing. It's sensational, and we're using your documents every day.
Okay, thanks a lot for that. See you guys.
See ya. Bye.